All right, welcome to this video. In this video, you are going to learn about options. You are going to learn basically about the unknown. I've been spending 2 years of my life, and I started with $500,000 of investing into the options, thousands of different trades in the SPY mostly. Over 6 months, lost most of my money, and spent the rest of the last year and a half mastering options and trying to just fully understand them. And basically, the comprehension I have of options right now, I believe, can be applied to any symbol equally. And it will give you a better way of comparing one option to another, and comparing one company to another, and comparing the profitability of each individual play. And then once you decide on a company and you can decide on the movements with the knowledge that I share, you should be able to kind of locate exactly where you think the best option play is yourself. It should kind of be a natural process. Like, you don't have to be at the exact right strike, because within like 5 to 6 strikes of each other, if you're betting like at a far money away, they're all going to make a lot of money. So there's no wrong play. I mean, if you want to be precise about it, you can definitely get more accurate. But yeah, so I want to make this video. I wanted to make it before the market opens tomorrow, so that if you guys know anyone, you can share it with everyone you know, but also that people can, maybe if they've been thinking about investing with us, but haven't pulled the trigger yet, they can gain the knowledge themselves and the confidence themselves of why we're so confident we're going to make so much money when the stock price doesn't move that much in comparison to what the people buying the stocks want it to move. So, I mean, if you think that the people that have bought the stocks that didn't sell at 20, didn't sell at 15, didn't sell at 10, didn't sell at 5, didn't sell at 8, and every other price that they've been able to bounce this thing to, but you think that they'll sell before 40, like, maybe you're right. Maybe they'll all sell at 30, and maybe I'm totally wrong. But I mean, they all say they're holding to 2,000, and then the ones that come in and say you guys are crazy, they're saying 100 to 200, and I'm only asking for 40, and I'm cashing out almost everything before 40. I'll leave a little bit just because I know that we're gonna build this money, and then we're gonna come back and gun the stocks, and so the little bit that I leave in there is gonna turn into like unbelievable in the money value that no one thought was possible, is what I'm feeling. Oh, let me add one more thing to my notes before we get started. Let's do where? What was it that I just thought of? Crap, I just forgot it and I just thought of it. Oh no. It was something about intrinsic value. Frack. I should have just wrote it down. I was trying to find the place that I could put it, and then I forgot what it was. Oh well. All right. So let's go ahead and get this video started. So before I go in and I try to prove to you guys that if you understand the principles of options that I understand, then you can look at any option, compare it to the value of other options. You can think about where you think the stock price is going to move and have a rough idea of what you think you're going to make. And you'll be able to understand the difference between expensive options and cheap options and what makes those prices exist. And then ultimately, what I believe is that when you understand options the way that I understand options, you no longer need to think about Greeks at all. And I honestly, like, there was a point where I was learning the Greeks and it was making sense. And then, like, I just dropped all that research and I just went on to my own thing. And I'm so glad that I did that, because like when I listen to people that talk about Greeks and when I ask them questions about like how to value an option or if the stock does this, which one's going to profit the most, like their answers are very, very skeptical. I'm skeptical of their answers. Like they just don't sound like they know anything what they're talking about. So basically with the options, you're gonna have a better understanding than like the people that like call themselves quants. You guys are gonna understand options better than the people that call themselves quants right now, and they get hired by the big hedge funds. All right. So before I go on, like that all sounds very impressive, and sometimes I may sound super like confident and cocky and arrogant. Um, let's just be totally honest right now. I am totally an idiot most of the time. There's just a couple things that I feel like I've mastered that I'm better than anyone in the universe at. And I believe that those things happen to be the most valuable things that anyone could have mastered in a lifetime. And so, yes, I do have a lot of confidence, but yes, I'm also aware that I'm totally human and I'm totally fucked up and I'm totally stupid a lot of the time. And like, so for an example, I just found out yesterday, and I swear to God, like you could, like, I roasted somebody so hard for not knowing this. And then I found out I was wrong like instantly after, and I felt so embarrassed. But basically, I could have sworn, like, I would have bet so much money against anyone that AMC movie theaters also owned AMC movie channel, and that they also had the streaming providers of like 5 million subscribers on their movie streaming or movie channel streaming thing. And so obviously I'm wrong about that. And like, I don't know why no one's corrected me. I feel like I've said that multiple times on this live stream. I don't feel like no one's corrected me. So I don't know what's up with that. Anyways, it doesn't matter. It doesn't change the numbers. It doesn't change any of the beliefs. Like, we're going to go deep into the numbers. Like, we'll go deep in the numbers than anyone's ever gone into the numbers. So don't worry about that. But let's see here. So if I've attacked you, if I've embarrassed you or anything, or you felt like I was overreacting, I apologize. Sometimes I do. Like I said, I'm not perfect. So, like a couple people out there, like Dwan, I'm sorry if I offended you yesterday. I love you. Thank you for coming back. What else? Intrinsic value. All right. So first thing we're going to go over, which a lot of you guys have already seen, is the intrinsic value. And this is important to understand before we even go anywhere else with options. So if you buy an option, like basically most people buy options intending to carry to expiration, where there's a few people that swing trade options, okay? And we're more on the style of swing trade options, except for this GME AMC event so huge that I'm not really interested in swing trading it. But I will teach you guys how to swing trade the AMC and GME and anything else. Okay. So basically what we're going to see here is to the left right here these are strike prices. So when I looked at this data, the SPY, which represents the S&P 500, this is where you can buy stocks or options, and the current price was $323. Right now it's like at $400. So this was a few months ago. But basically the 324 strike and the 323 strike, in between that is right where the at the money price was. Okay. So the at the money price is 323 in this example. So the 324, the extrinsic value, the ask price of the first strike that is out of the money is $2.70. So basically you can figure that the extrinsic value of this option, which had a week to expiration, so 1 week to expiration, was $270 a contract. Okay. Well, every strike after that, the further the percent it is out of the money, the less of a percent it is of the original out of the money value. So it goes from 270 to a smaller percent of 219 to a smaller percent of 174, because one option contract is 100 stocks. So whenever you see an ask or a bid price, you just know that it's times 100 for the real price that you actually spend. And so if you want to sell your contract after you buy it, we never sell options. So we're never selling, shorting the market. So we'll buy at the ask price. And then after we make our money, we'll come in and we'll sell at the bid price. Okay. So you sell at the bid price after you've made a profit, but in order to get in, you got to pay the ask price. So if you just bought in at the 327, it cost you $136. If you immediately regretted it, you could cash out for $133. but there's also 50 cent per contract trade cost. And so ultimately you'd lose $4 in doing that. If you just bought in and sold out, you'd lose $4 of a net $136. So your $136 would have changed to $132. And now if the stock market goes down, you lose money. If time passes, if a week goes by and 327 did not make it in the money, you lose all of it. So let me explain that. So I made a little example right here. What happens if I buy this and I'm going to hold it to expiration, and by expiration, the market goes up 1%? What happens if it goes up 2%? And what happens if it goes up 5%? Well, at 1%, the stock goes to 326.23. So if I subtract the 324 strike from the 326.23, because I only like to mess with out of the money options, like we'll discuss in the money options later, but not right now. So 326.23 minus the 324 strike leaves us $2.23. Times that by 100 is $223. So now we made $223, but our cost was $270. So we had a net loss of $47. The next one, we had a net loss of $96. The next one. So basically, if we think the S&P/Y is only going to move 1% up, then there is not one strike out of the money that we are going to consider buying. If you want to buy an in-the-money strike, you can, but there's no difference between that and just leveraging a bunch of stock. Like if you have a portfolio margin account, you just buy a bunch of stock at the highest margin, and you're in the same position as buying a deep in-the-money call. So they're like buying a deep in-the-money call doesn't make sense to me when there's so much stock available on the market. I mean, maybe the hedges do it to hedge their losses and stuff without moving the stock price. Like something like that can make sense, but I've heard that is illegal. So like, I guess we'll find out soon. So if the SPY went up 2%, the $276 or the $270 grew to $276, which was a net ROI of 102%, while the $219 grew to $227, which was a net ROI of 104%. And then everything else lost money after that, but understand that one contract can never lose more than the actual cost. And so I just don't know how to like make this like equal to or less than this. But basically on this one, it says you lose $1,300. You actually lost $2 if you had one contract. So now we go to the 5%. And if we went 5%, our $270 grew to $1,245 for 461%. The next strike grew more than that. The next strike grew more than that. And you can see it's a linear progression of how much each strike grows after the next one. And the best strike was actually 336 for $8 a contract, which turned into $307 a piece, which is better than $11 contract turning into $404. And so basically, if I decided instead of doing one contract at $270, I did 34 contracts at $8. That's investing $270 as well. And now my $270 actually grows into $10,361 instead of $12,445 instead of $1,245. And it was the exact same amount of money invested in the exact same stock and the exact same expiration date, just a different strike. Just by choosing the right strike and investing the same amount of money, I can make 38 times my money instead of 4 times my money. Like you guys got to understand that before you even understand anything else, you got to understand intrinsic value. Intrinsic value is very, very simple. And so we're going to go over a different way to understand intrinsic value. This is how to understand intrinsic value at expiration. But what if we can understand how to gun a stock and short squeeze a stock that has basically infinitely zero extrinsic value, where no matter where you look at the option prices, whether it's 1 day or 2 years, it's all worth basically nothing, and it's the cheapest it could possibly be. And so if you buy these and then you hit in the money, you just make fortunes and fortunes and fortunes of wealth. And because you can buy so close to the money, if we buy so close to the money and then gun the stock, the price is going to go up, and then our options are going to make way, way more than what we actually put into the stock. So when we cash out the options and take the extrinsic value from the hedge funds, we're taking way more than we put into the stock to actually make it go up, to make us make those profits. That's the beauty of a short squeeze. That's what Jim Cramer talks about in his article. Jim Cramer in his article was not talking about buying deep out of the money calls, letting them get in the money, cashing them out, and then gunning the stock to make like an infinite squeeze happen. What he was talking about was buying 10% of your money into deep out of the money calls and then gunning the stock with 90% of your money and then cashing out your options for more than what you put into the stock. But because we have the retail doing the gunning of the stock for us, all we have to do right now is buy the AMC stock. And so I'll get more into that later, but that's all we're doing right now. After that happens, we can have other conversations about other stuff we're going to do. But right now, AMC 2023 is 88% of my account portfolio, and it's going to remain that way. All right. So let's go on to the next part. Okay, so I've seen a lot of people in my chat reference optionsprofitcalculator.com. So I will get copies to everything that I'm showing on here. I'll create a little link on all my Dropboxes or like my Google hard drive, and I'll create a little folder to give you guys access to it. But yes, so let's go to optionsprofitcalculator.com. So let's do this real quick. So this is AMC. This is 1 week to expiration. Okay. So this is 1 week to expiration. And if you bought the $10 strike for 58 cents a contract, or $58 after you used 100 times multiplier, and AMC goes to $40, you'll make 51 times on your money. Okay. 5,159% is 51.5x on your money. So if you put in $58, times that by 52, and you get $3,000. And so that's what this is saying. Okay. It's exactly what this is saying. So the total is $3,058. It costs us 58. So our net profit is $2,992. And the extrinsic value, if we bought at $950, what's the intrinsic value, right? The intrinsic value is $30.50 because the strike was $950. So 40 minus $950 is $30.50. It's adding 0 extrinsic value to your options. And that's actually how it happens when you get into the money. So let me show you something. Instead of buying at the $10 strike and letting it go to 40 and collecting mad 51x of my money with intrinsic value, what if instead we go out here and we find the cheapest available option? So we see that the cheapest option available is $3 and $4 a piece. So I'm going to do $27 strike, and then I'm going to calculate this price. Instead of making 51 times on my money when AMC gets to $40, I now make 369 times on my money. Does everyone see this? And that's all. It's 0 intrinsic value. That's 100% extrinsic value. I'm going to cash out right there. I'm not waiting for this to expire, because look at this. Every day that it holds at 40, I go from $14.77 to $14.39 a contract, to $13.95 a contract, to $13.51 a contract, to $13.12 a contract, $12.96 a contract, and then I expire at $12.96 a contract of profit. Why wouldn't I just cash out at the $14.77? So I'm cashing out as early as possible once I get all my extrinsic value. Because check this out. Check this out. So I make 369 times on my money from 10 to 40, but how much do I make from 40 to 80? Anyone know that question? So I make from 10 to 40, I make 369x of my money. For that same amount of growth going up again, I make 4x on my money. If I would have just bought stock, instead of just making 4x, like I would have made 1x on my money, right? So like we're barely beating stock. Like I made 369x of my money right here. And now this growth, I'm only making 4x on my money. Ooh, that's a hard pitch for me, bro. Like I'd rather just buy the stock and like support the cause and generate the catalyst, right? Send the stock to the moon. Like we're only talking about pennies now. If I've already made a fortune, why am I worried about the pennies? Why am I worried about the pennies? Now check this out, guys. So this is what's called the implied volatility. Their implied volatility machine is broken and it does not accurately calculate how to price an option. So for example, when I bought my GME option, which expired in a week, which cost $26 a contract, AMC is much, much cheaper. So that was 100% out of the money, right? So let's go $19 strike is $7 a contract, where mine was $26 a contract when I made 150x on my money, or 170x on my money. So this is $7 a contract, which is 3.5 times cheaper, okay? So if I calculate this one at, once it hits in the money, which is right here, this is saying, so let's, hold on, let's make this graph easier to look at. So let's go to in the money, which is going to be right around $20. So our strike at in the money is about right here. So we make 46x on our money in the same situation that I made 150x on GME, even though the AMC options are cheaper. No, 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 no. What I'm about to show you math later about the intrinsic value will prove to you the cheaper the option, the more the profit it makes, even when the price goes up. Even if the total contract value is less, the ROI per contract is much, much more. So we know that this calculator is wrong, because this is saying 46x on my money when I know that I already made 150x of my money in GME, when GME was 3 times as expensive in the same situation. So I know this is wrong. So how can we kind of try to find the right answer? Well, if I change the implied volatility, they have a max on their website, and I'm not sure what the max is. I just know that this will hit the max. But basically, there's a max on their website of the most that they think it can hit or whatever. And when I hit that max, if we look at this, basically they got the max limit at whatever the strike is the most that one contract can be worth, is whatever the strike value is. And they're saying the extrinsic value can never be higher than the strike content. If that's true, if that is true, then I will probably get reduced to 30 to 50x on my 2023s, while people in June will make like 100 to 200x, while people that are buying in 1 week to expire will make like 1,000x, right? Well, I'm not really worried about that. Like, I got a whole plan, and as long as you guys follow me and you follow our plan, like the AMC thing is just the beginning. It's just the first play. We got a whole plan. So we'll go over the plan here in a minute. And so I just want to show you that, but basically we proved that the automatic value that it calculates, because it was 3 times less potential than what my GME profits actually were, but they're 3 times cheaper. So it should be 3 times more potential. So basically it should be saying 500x, but instead it's like, it only shows 40 or 60x or whatever it was. And then when I max out their system, their maxed out system at least says 285x, which is at least double than what I got on the GME thing. You hear what I'm saying? So this is kind of like a way to, like, when I go over optionsprofitcalculator.com, I know this site is bogus. And like, basically I can do this site, like as soon as we make some money, or as soon as I get money behind me, regardless how I make the money, like I'm going all into building my own E-Trade and my own like optionsprofitcalculator.com. Like I want to solve this universe one day, right? And so if I show you guys this right here, this is pricing.racestocks.com. And if I go to SPY, I go to call, you can go to a lot of these hours. The short hours don't really work that well. For whatever reason, options data is very, very complicated, and we got like billions of records, so it takes a decent amount of time for like some of the things just kind of glitch out. I only like to search by IV right now, and this like 100 hours to expiration. I know exactly what data it's going to give me, and I know it's good and clean data. So like I just like to use this one, but you guys can go through, and most of the data is good and clean. As long as it spits out the data is good and clean. It's just not every hour has a lot of records, where this one has a ton of records, and so it's good to look at and kind of understand exactly how I want to price options, and exactly how I think options are priced, and why I think you guys will understand. And like, I think this will make it easy for you guys, and you guys will be more comfortable with options and talking about options, telling people you invested in options, telling people you understand the risks of options, because you can never lose more than you invest when you're buying options. And so lots and lots of good things, guys. So I'm going to go to show all prices, and then I'm going to come down here and I'm going to hit all right here. Alrighty. And then the way that I always look at my things, and I talk to people about this when I'm going over my site, like I've tried to pitch people on like raising money and stuff, and I try to like teach them stuff thinking that will help them. It doesn't always help, but you guys will see that the strike price and the stock price are much, much different on all these records, but these guys are much, much more similar than any other two records that I own. These two right here, because they're both 0% diff from strike, because they both at one time, at the same time that I collected the record, one on July 20th and one on July 21st, there was 100 hours to expiration when I collected the record, and they both had an approximate IV of 0.2 and VIX of 2.5. And basically the VIX is the fear gauge of S&P 500, and the higher that goes, the higher option prices go. And same with implied volatility. And so the higher the VIX goes, the higher the implied volatility will go. And so basically, if you look, these two are the closest records you'll ever find. And we'll see that these two closest records you'll ever find, there is a window of $5.80 to $6.02 between the ask price, or $5.78 and $6 on the mid price, or $5.77 and $5.98 on the bid price, right? So like it kind of gives us a range of where we can imagine where the price is going to be if it ends up back in this situation. And the problem is that you can hit a 2472 VIX and a 0.2 IV 100 different ways. Okay, so basically, like I could go up 100% tomorrow, or I could go up 10% every day for 10 days, or I could go up 1% every day for 50 days. And all of those different ways, you hit 100%, but in a different amount of time. And so all of those different ways of hitting 100% will set the option price at a different price, because the IV, somebody needs to mute their mic before I boot you. But the options price will, always be consistent in that linear thoughts. So basically you can look back at the historical of the S&P Y and say, if it moves in the next 1 month 10%, then all right, I'm booting you. Nope, I'm booting you. You don't get to fucking listen to me and not fucking listen. Oh man. God, that pisses me off. Like, what the fuck? Are you guys here to listen or not? Get the fuck out of my stream. Get the fuck off my Discord, you pussy ass little bitches, if you aren't here to listen. Get the fuck out of here. Get on my YouTube for that shit. God damn it. You guys are so dumb. Fucking don't appreciate nothing I do for you. I'm fucking sick of that shit. I'm going to literally start kicking all you guys out of my Discord. You keep showing disrespect like that. All right. So the same thing applies. Like if you look through all this fucking shit, you'll see that this is 0.001% out of the money. This is, and then if we keep going, so this is going to be, this will be, so this is in decimal form. So this is 1% out of the money. This is 1.5% out of the money. So if we look at these three right here, we got a window of an ask price of 325 to 441. And so you can see that that's a pretty huge window, right? But if we look at the VIX and the IV, we got a 24 VIX right here, a 29 VIX right here. We got an 18 IV right here, a 22 IV right here. So it makes sense that this price is much higher than these prices, because we're much higher than those numbers. And I told you that these numbers also predict the increase of price in here. And so basically what you can do by taking this logic right here, you can use the mathematical formula, the historical performance of the stock, and you'll be able to see exactly what, like rather than this bogus crap in optionsprofitcalculator.com, where if I just reset this thing, right? So let's go to GME, then let's come back to AMC. If I go to select option and I go to the same one that so basically 100% out of the money. Let's just call it $19. And then I go back to their auto calc Remember their auto calc says once I get in the money, I get a 40x on my money, right? I invested $7 and now each contract's worth $282. Well, remember the GME one in the same situation where they're 3 times as expensive, only or made 150x on its money. So when this options profit calculator tells you that you're going to make 40x on your money, it's totally full of crap. It's going to be anywhere from 300 to 1,000x on your money, but don't even worry about that because check this out. Remember how I told you? So let's take a look at we got the $7 strike right here. Let's take a look at the 2023 $19 strike. So we'll just say $20 strike, and we're at $3.50. So if we take a calculator, we got $350 divided by the $7 per contract. We're 50 times larger than the amount, right? So let's check something else out. GME's already had a nice pop. Now, like, let's assume GME's only had that like 100% pop in their option value, because that's where basically the pricing is right now. Basically, it's where it was when I made my 100%. When I got to 100% in the money with my $100 strikes, the option prices are exactly the same pricing right now. Even though they're up another $100, the way that they're slowly raising the price, the only way to not get beat by this is to bet on the 2023 expiration options. But check this out. So if I just look at the 192.50 on today, it's $1,700 per contract. If I go to 2023 and I look at the money of 195, it's $11,800 per contract. It's 10 times more money. So like whatever that number goes to, whatever my $7 contract goes to, my super cheap contract on AMC that expires on 2023 is going to be worth 10 to 100 times more than that because I got that much more theta on it. Depending on whether you got 1 day to expiration or a week to expiration, drastically changes the amount more theta I have than you. Does that make sense? And so when your thing has 1 day to expiration, the amount of theta I'm going to have compared to you is going to be infinite on my 2023. And so when your number grows and my number grows, I'm going to have infinite more growth than you. Think about that for a second, guys. Like, so that's why the 2023 is like a rock, like it's money in the bank. Now I'm going to talk to you guys about GME, AMC, option pricing. I'm going to talk to you about a different way to understand intrinsic value without holding to expiration. Where does the opportunities lie? I'm going to talk to you about the AMC current potential. I'm going to talk to you about the companies, their market caps, the number of stocks, their profits, their revenues, all that good stuff. Alrighty. So what we are going to look at now is this guy right here. All right, I need some water. Hang on a second. All right. So I have 3 examples right here of 3 companies, and the only way that I like to look at a company right now, the only thing that I'm interested in right now is PE ratios, retail investment, and I believe that whatever's got the retail investment that is anywhere between 1,000 to 5,000 earnings versus profits, which is like Tesla and a bunch of other tech companies. I believe they are all going to crash. And I believe that where retail supports are all going to skyrocket, plus one other company is going to skyrocket. In this example, that example is going to be Nokia. But as I go over this research, you will see my hesitancy with Nokia, and I've already found a dozen other companies like Nokia's option pricing that also have a low market cap, a low EP. And so I'm doing a little bit of research to see if I put $1 million in a small company with, let's just say, $1 billion market cap versus $1 million into a large company like Tesla, do I get the same percent change in stock value? If the answer was yes, then like Nokia would be totally fine. But I got to do some research. And basically, by the end of this video, I'm going to be writing out an honor code on a Word document. It's going to be very simple, one-page thing. You answer 3 questions, and then you sign it and send it back to me. And basically, if you sign it and send it back to me and answer the questions, there will be one other video where I go over exactly what we're going to do. And then the only other thing is, and maybe I'll go over exactly, maybe there won't even be another video. But if nothing else, the one thing that it will get you is access to my Discord. I'm going to make my Discord private and boot anyone that doesn't fill it out. And basically, once we make our money on AMC, the people that are left in my Discord, I am hoping that you follow me on the rest of the plan. And so this is really going to help you understand how I feel about the rest of the plan, where my head's at. And if you like it, you can join me. If not, the YouTube will be for everyone, GME and AMC. The Discord will be for the people that want to basically start a retail hedge fund. Like, we are a retail hedge fund, right? If we get big banks, if we get money in the bank, like if AMC pays tendies, then yeah, we are the hedge fund. So that's where my head's at. And let's go ahead and begin on the research. So GME currently has a rough market cap of $13.45 billion. Their current revenue of last year was $7 billion. Let's be generous and say $1 billion of profit, which gives an EP ratio of 13.45. Does that make sense? So if they profited $1 billion of their $7 billion, which I know it was actually less, but let's assume that on their best year they will. And I like to base a company off what I think their best year could be based off their historicals, not what I think their worst year is during COVID. Like, anyone that bases a company off COVID, I think is completely moronic. And I don't want to deal with those people. So basically, if I do 1 billion and I times it by 13.45, I get 13.45 billion, which is the total value of all the 70 million shares times the current stock price of 192. Okay. Before COVID, or before the January boom, the highest GameStop ever hit was 55. The low was 2. That might actually be different in the year 2000. I probably only went back like 5 years, but I'm talking about the last 5 or 6 years. GameStop has a high of 55. But the current stock's 192. So the EP ratio is 13.45. Remember, guys, so I want to show you guys this. Like, you guys got to understand what the EP ratio is. So if I do Tesla profits last year. All right, guys. In full, revenue climbed to 31.5 billion, up from 24.6 billion in 2019. And then they profited, fell to 5.4% from 9.2%. Basically, what I saw for the 32 billion in the full year that they had, they profited $700 million, which is about 5%. Oh, no, 10%. It is 10%. So they're profiting about 10% of their money. Okay. No, that's not 10%. It's 5. It's not even 5%. It's 2.5%. It's 3%. It's 2.5 to 3%. Interesting. So it's 2.5, 3%, but they've had their last 2 quarters during COVID have been crazy high. I'm sure they're getting big banks from the government. Like, I seriously got no doubts that like half of their revenue comes from tax credits. All right, guys. So we know that 31.5 billion, and we know it's 700 million of profit. And if we go to highest PE ratio stocks, we're going to get market beat. Let's see what number 14 is. I'm curious. What is number 14? Number 14, out of all 26,000 stocks on the market, I believe it is. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Tesla is number 12 at, see, it says 1,328, which doesn't make sense because the current price is 661. The market cap is 635 billion. And the profits are, let's just say 635 million, right? Or 700 million. So if it's 700 million is the profits, hold on, maybe that's irrelevant. So it's all about the number of stocks, right? That makes sense. So I got to times this by the number of stocks. And unfortunately, I don't know how many stocks are in Tesla, but I actually don't even care. We don't need to know that. All we need to know is that the PE ratio is 1328. And that right now the market cap is at 635 billion, which is 1,000 times higher. See, that's my thing. Like I saw that last year was 700 million in profit. And so if it's 700 million in profit, if you times that by 1,000, you get 700 billion. So the market cap is at 635 billion. So the way I read this is this should say closer to like 900. And so maybe this just hasn't updated from when this used to be 900 billion. And they just haven't updated this number, but it's like basically the PE ratio should be about 900 right now on Tesla. And I don't think it's fair for like for 100 years, every company has had a precedent of selling anywhere from 3 to 5 times their value. If you're like a super tech company, like you get away with like 7 to 10 times your value. Maybe if you're Elon Musk, you get away with 20 to 50 times your value, right? But even if you're 50 times your value, and right now you're 1,000 times your value, then guess what? That means you got to come down 950 times your current value. So you're coming down 95% of your current stock. So if we say that the current stock of Tesla is roughly 666, and I times that by 0.05, Tesla's value is going to drop to $33.3. That's its true price. And that's assuming Tesla's worth 20 times its earnings, which would be the greatest valuation of a company ever sold at if they were able to sell their company at that price. Like nobody sells their company for more than 20 times their earnings. They might sell stock for more than that, but then like it crashes, right? Every 10 years, every 20 years, it crashes. So that don't count. No one's ever counted that, and they call it a risk and they call it a gamble. All right, guys. So let's keep going. So right now, we just looked at Tesla's PE ratio, and it's roughly 1,000, while GameStop's 13.45. So when people like me, Kevin, are telling you that Tesla's got everywhere to go, but GameStop's at its top dollar and is obviously going to crash, like just look at how mentally retarded they look. I'm not making this up. Like they're talking about their thing that's overvalued by 100 times more than our thing and telling us that we're crazy. It's unbelievable. Like the guy's a spook. He works for the CIA. Don't freaking trust me, Kevin. He works for the CIA. It's not his money. He's gambling, and that's why he keeps buying and buying and buying, even when all these like fake bull, like their bull traps keep happening, because he wants everyone else buying, because he knows that if he can convince the world that there's not going to be a market crash, that there might not be. But unfortunately, inflation's going to run that whole plan of his. All right, so let's keep going. So the call open interest in GME, there's 312,000 contracts. So this is super important to understand, guys. There are 312,000 contracts. And right now, if you look at option contracts with 1 week to expire, they are 20 times more expensive than option contracts than AMC to expire. And the AMC ones are like 10 times more expensive than the Nokia options 1 week to expire. So what you got to understand, when there's 312,000 contracts here and there's 3 million contracts in Nokia, there's actually a lot more money in GME option contracts than there are in Nokia or AMC because there's actually 20 times more value. So there's only 3 times more contracts in AMC than GME, but the value is on average 20 times more per strike. So basically, if you times the 300,000 contracts by 20, you'll get 6 million is like a dollar comparison compared to the 1 million of AMC. So it's like 6 times the money in GME open interest. But here's the thing. The 300,000 contracts, like open interest, when you're talking about a squeeze potential of a company, open interest is not about the number of shorted shares, synthetic shares, in relation to the number of total stocks. It is just about the number of total shares and the amount per of option contract. And so what I'm about to show you guys here in a second is that the cheaper the option price, the more that it profits. And if the cheaper the option price and the more that it profits, then what that means is if two open interest has the same number of contracts, whichever open interest has the cheaper contracts overall can do more damage to the hedge fund dollar for dollar invested or contract per contract invested. Does that make sense? Because the ROI is going to crush. And so where the ROI in the expensive options is going to be way, way less. And I'll go over that here in a second. So basically the idea that you got to understand with open interest when looking at them equally, the higher the contracts are, the less profit they make. The medium the contracts cost, the medium profits they make, and the smaller the contracts cost, the more profits they make. So I went and I collected some information last week on GME and AMC and Nokia, just 3 different companies, okay? Basically, I found several companies that match in Nokia with low current stock price, high open interest contracts, extremely cheap, like the cheapest possible option. A contract can never be worth less than 0.01 or $1. And after your fee, the cheapest you can ever buy any option contract on the entire market is $1.50. A lot of symbols never even allow it that cheap. And like the cheapest is $10.50. But Nokia is one of those ones that's $1.50. And so that's why I'm showing it as an example. The only thing that I'll say about Nokia is that there are 4 billion shares in the market, where there's only 400 million shares in AMC and there's only 70 million shares in GME. And so we are going to do some research to find out if this 4 billion shares makes it harder to squeeze. And if it is, then Nokia will not be the stock that I squeeze. And I will have to let you guys know of one of the other symbols I've been researching. And that will only be provided to people that sign the honor contract, the honor code. All righty. So I looked up, like, in times of the company's stress and in times of booming, what are their low and high market caps? GME's been at low as 300 million. So when you compare that to their current market cap, they're 60 times higher than that. The high market cap is 20 billion. So they're about half of that right now. And that was when they went to $483 a share back in January. AMC has a 400 million market cap, or as a low, 6 billion is a high, current market cap of 4 billion. And so their stock price was at a high of 37. Their low was $1.83. They're only 10x where what their low was. They're only 10x above the low, and where GME is 60x above the low. And so basically, if you look at if you thought AMC and GME were going to do the same thing and you think GME might be at their top or close to, or like they're eventually going to get to the same price, then by buying an AMC, you'll make 6 times more profit if AMC and GME ended up at the same time, at the same price. I'm not saying it's going to happen. I personally believe GME will end up at a higher price, but we're talking about options right now, and we're talking about just the next 300% ROI is I want to make as much profit as possible. After that is when I will buy a lot of stock in GME and AMC, and potentially Nokia or a different company that I want to own and squeeze before I do the gunning of the stock of AMC and GME. And so if we look at Nokia, they got 4 billion shares. Their historic high was $60 a share. Their historic low, which was recently, was $2.50 a share. They're currently at $4 a share. Their open interest is 3 million contracts. Their contracts are the cheapest imaginable contracts. The low market cap was 15 billion. Their high market cap has been, it's actually 250 billion back in the year 2000. And their current market cap is 24 billion. So they're about twice as high as the low that they hit. Earnings high was 7 billion. Earnings low was 5 billion. Earnings average was 60 billion. I believe that this is inaccurate. I believe this was revenue. And so their revenue is actually closer to GME's. And so when you guys see earnings right there, just know that I meant revenue. And this was actually 4 billion. So don't worry about the earnings very much. We already kind of went over that up here with the market caps and everything. And then the assumed held profits. And so basically, I believe that about $750 million went into GME from the retail from the time that it hit its bottom all the way to January. And then I believe that a lot of people got in before January and that they're up a mad amount of money. And when I look at the cash outs, I believe that there's probably about $10 billion in profits between like DFV type people and all of his followers that haven't cashed out most of their funds, or at least not half of their funds. And so I believe that GME has the most retail support right now, just because the profits are still holding on and they want to see how high it can go. I believe that AMC has the most actual retail support of $2 billion that has been put in and not taken out after it was put in. And I believe that they've also probably got about another $2 billion in profits that's still being held from retail support that bought in when it was as low as $1.83. And then I also believe that Nokia has about 100 to 200 million, which is not very much. And basically in January, they got billions, but then it all sold out immediately after when they started like halting the market and stuff. So basically, I assume that there's no profits in Nokia right now. And that anyone that made profits when it did spike a little bit from $2 to $6 probably cashed out already. And that's okay, because whether it's Nokia or a different company, we're going to squeeze the company, and that is super cheap options. And yeah. All right. So now that we've talked about basically all the data, let's talk about this real quick. So when I talk about intrinsic value earlier, I showed you guys how a different strike on the same expiration could profit more money, a much more money, if you have an idea of how much the stock price is in a move by time expiration happens. But now I want to show you how to maximize the cheapest possible contracts in the market into its maximum earning potential through a short squeeze, through intrinsic value, but not holding until expiration neither. And these ones you actually could exercise because all of your value is basically going to be intrinsic value. So here's the thing, guys. Let me go over this real quick. It's actually super important. Basically, oh man, please don't let me just forget it again. It was the same thing that I forgot earlier. It was about the intrinsic value. Oh, I think I already went over it, actually. I showed you guys how I can make like the 500x going to in the money, but then the next in the money profits is only 4x. And so I did show you guys that. So you guys should already have a good idea of what that means. And so typically I don't like to hold my options. Like typically everything I've talked to you guys about options with AMC and stuff, we're going to be cashing out the extrinsic value. But when we go squeeze squeeze another company with those profits, like Nokia, for example, it could be, we'll see what happens. Basically what we see is that on the 1 week to expire. Okay. So on the 1 week to expire, $690 strike, which is roughly 300% out of the money. Each contract is $40 after you do the 100 times multiplier. The 1 week to expire out of the money contract for $29 strike, which is about 300% out of the money, is $4 a contract after the 100 times multiplier. A 1 week out of the money expire, 20% out of the money, not 300%, 20% out of the money is $1 a contract. You can go look at Nokia's next expiration day right now, April 9th, and you will see that it's $1 a contract for the $5 strike. Obviously, if we start buying contracts, it's going to push it up to $2, $3, $4, $5. But anywhere between that $1 to $5 range is quite amazing when you're going to squeeze it and you know the squeeze is going to happen because we're bringing in our own volume as if we were the hedge fund. And so it's quite amazing what's going to happen. And so check out this math, guys. If I buy at the $4 strike, or if I buy at the $5 strike on Nokia, a $6 contract or a $1 contract, including the 50-cent cost, and if the $4 strike goes into the money to $8, or if the $5 strike goes into the money to $8, which one makes more money and why, and how do we mathematically count the intrinsic value? Oh, that was the one thing I wanted to show you guys. Okay. So I didn't go over that very well. I'm going to do it well this time, okay? So that makes sense. So if I go to AMC, I go to select option, I go to 1 week, and then I go to, let's just say this guy, select, oops, okay. And then I go to calculate. All right. So what I want to show you guys is this gets in the money at $27, right? Let me show you at $35, or no, we'll just say $40. Okay. So at $27, you've made 142 times on your money. Sorry, 127 times on your money at $27, 127 times on your money. Each $4 contract is turned into $500. Now, we know it's going to be more than that. We know that their thing undervalues and all that good stuff. So don't worry about that for now. But let's just focus on what the numbers are saying. So we know that, right? We've made, like, basically with zero intrinsic value, we've made a lot of money. 100 times our money, right? The next $27 to $40, we only 3x that money, which is a lot. So now we're at 300x our money. But let's calculate this real quick. How much intrinsic value do we have? The intrinsic value we have is from 27 to 40, that'd be about $13, right? $13 of intrinsic value. This is saying that you're going to have $14.79 of total value. So you have $1.79 of extrinsic value. Well, what was our extrinsic value at 27? It wasn't no $1.79, it was $5.11. So by letting it go in the money, they take your intrinsic value. So your intrinsic value dropped from $5.11 to $1.79 because as you get more and more intrinsic value, they depreciate and depreciate your extrinsic value. So I told you guys I was going to teach you how to swing trade AMC if you don't want to just be patient and then you think they're going to keep halting the stock. You think it's going to go up and down, up and down, up and down. This is how you swing trade AMC. You come to the 2023. Now, I put all my money on the $40 strike. I'm happy here. I bought in my average contract for 374 contracts is $310 a piece. I've lost 33% of what I've invested into here. I'm happy. I'm going to hold it. I'm not selling these until it hits 40. I might sell 5% between 25 and 30, but just to get my cost basis back. But I'm not selling the majority of my funds until it hits 40. And so here's the thing. If you want to play it differently, what you got to understand is that when AMC goes to 20, the $20 strike on the 2023 is going to make more X's on your money than my $40 strike. That's why I'm not closing at the $40 strike. So if you want to come in and put 50% of your money on the $40 strike, just in case it all happens in 1 second, but then put 50% of your money on the $20 strike, and the second it hits 20, cash it all out, and then load it up on the 30, and then the second it hits 30, cash it all out, and then load it up on the 40, or if it goes to 20, cash it all out. If they halt the stock, let it drop back down to 10, then throw all your profits and everything else back into $20 a strike again when it's back to 350. Does that make sense? And so if you want to swing trade it, put some of your money on the $40 strike, put the rest of your money on the 20, and every time it hits, cash out most of your money, either let it drop again or move the money down to the next lower strikes. Because if it goes to 20 and I put all my money on the 20 and then it goes to 30 and I already put all my money on the 30 and then I cash out there and I put all my money on the 40 and then it goes to 40, instead of making 200 to 300x on my $40 strikes, once it finally hits 40, I would have made 1,000 to 2,000x by following all the way down. But here's the thing. If you put in the 20x and then they go to 20 and then you cash out and you try to move the 30x, but it goes straight to 40 and you cashed out and you didn't get a hold to 40 and you didn't get back in time, like you just lost like you're not even gonna make more than 20x, bro. Like you only get 20x on your money. So I would rather take the what I feel like is a guaranteed win at the $40 strike of like anywhere from 50 to 200x. Like I just want my 50 to 200x, and then me and my posse that like the real followers that are understand what I'm saying, we're gonna go freaking short squeeze another freaking stock, and then we're gonna go gun AMC and GME. So I thought that was really important to understand that as you get more intrinsic value, they take away more of your extrinsic value. So for me, it makes the most sense to cash out all my extrinsic value and bet on a deeper strike, or forget about options and finally like focus on just gunning the common stock once we have enough money to do that. Does that make sense? So I hope that makes a lot of sense. All right, guys. So let's finish what we were talking about. All right, guys. So back to the $6 contract and the $1 contract. So each contract is $6.50. My $4 contract went into $8. So there's $4 of intrinsic value. For every $1 of intrinsic value, I 15x my money. So remember, we got to do that 100 times multiplier. So every $1 is actually $100, right? But because it's that 50-cent cost price, basically, every $100 you have, you can buy in 15 contracts. That's what I'm trying to say. So every $100 you have, because they're $650 or $6.50 a piece, you can ultimately buy $15 per contract for every $100. Every $100 you have is going to grow by 61x for every $1 in the money that it grows. So when $4 goes to $5, you're now $1 in the money. Your $6.50 intrinsic value has now grown to 61x. And so basically, because we have $4 of intrinsic value, this, I believe, should say 4. You get 246x on your $600 investment, would be a 40x on your money, or $22,000. Because you're $4 in the money, and every dollar in the money, you get 61x on your money. 246. If we assume $600 invested, you turn $600 into $22,000. Okay. And that's just intrinsic value. So this is the opposite play of what we're doing in the AMC. The AMC, we're squeezing for extrinsic value. This one, we're buying at the money because we're squeezing for intrinsic value. If I can find something that's only 20% out of the money and then push it 100% up, so my $1 contract now is at $3 in the money, and we go from $5 strike to $8 stock value. Now each contract is $1.50 instead of $6.50, and now for every $100 I can buy 66 contracts, and because there's 3 of the $3 in the money, that should be 3. Oh no. Then, so that's what I'm missing, right, guys? So I times it by, so every X for in the money is 15, times that by 3. So let's do this, times 3. Oops. So I get 46X for the, oh no, sorry, this is 4 because it's $4 in the money. So I get 61X on my money, which I already have right here, for just the intrinsic value. And now I want to invest $600 instead. So it'd be this times 6, because this was for every $100. And so we times that by 6. So we get that. And then this would also be times 6 because we've already calculated. Oh no, here's the thing. We got to do this 66X times 3. Then we do the 200 times 6 because we're doing $600 instead of $100. And basically by buying $1.50 contracts and going to $8 from $4, which is a net $3 in the money, our intrinsic value becomes $360,000 from $600. Let me make sure I'm 100% right on this because I believe I am. So we have $1.50 a contract. I want to know how much can $100 buy. So I do 100 divided by $1.50. And I should get that 66 number. Okay, so for every $100, I get 66x on my money. So every $1 of intrinsic value, I get 66x on my money. We're saying we get $3 of intrinsic value, so we get 200x on our money. And then we're saying instead of $100, we're doing $600, and we're times that 200 by 6, and we get 1,200. And then we do 1,200 times our $600 invested, and we get Oh, hold on. That's where I went wrong. Oh, there we go. So it should be the $1,200 times. Hold on, what is it? $1,200 times 100 for options. Is that what I did up here for the 33,000? Why did I do 90? That's weird. All right, let me do the math on this one more time. Like, guys, this is a learning process. Like, I'm doing all this like live. Like, you guys hopefully have good questions for me if this isn't making sense, but it should make a lot of sense. Like, this math isn't that confusing, and I'm just being an airhead today. So on this one, we had $6 a contract, which ends up being $6.50 a contract. We know for $100, we could buy 15 contracts, but we want to invest $600. So we can buy 61 contracts. If our 61 contracts hits $4 in the money, then it'd be 61 times $4 would be that. Because that's counting. So this 61's counting the 4. Then we times the 61 by 6 because we're doing it 6 times because we did $600 instead of $100. And now you just times this number by 100 and you get this number for an option contract. That makes perfect sense, which is ultimately a net ROI. Okay, so instead of 369x, we're getting about 4 times a better deal, and we're getting 1,200x, times that by 100, and we get 120,000. So if we figure out what is my actual earning ROI, it's old price minus, no, it's new price minus old price divided by old price is the formula for ROI. And we get 199x on our money by pushing Nokia to 100%. So $8, right? So if I get 199x on my money, 199x, right? Well, check this out, guys. So let's assume that the AMC squeeze happens and I only make $9 million, and you guys all make somewhere between that, right? Whether you're investing 10,000 instead of 100,000 or 200,000 instead of 100,000, like you'll either make twice as much or 10 times less, right? But you'll make 900,000, 9 million, freaking 18 million, whatever. We're going to cash out 90% of it. Oh, so no, I assumed I make 10 million. I'm going to cash out 90% of it for 9 million. 4.5 million going straight to my family, myself, my house, all the good things, right? The other 4.5 million, we're like the other 50% of the 90% that we cash out, you guys are going to join me in the squeeze. Okay. And let's assume that it's Nokia right now. Basically, I'm going to come in and I'm going to put 10% of my $450,000 into that $1.50 contract. So in best case scenario, I can get 300,000 contracts. But after like they go up and double in price, I'll probably end up with like 100,000 contracts for my 450,000 I put in there. Now you guys all got your contracts, which is equal. So you have $40,000 contracts or $4,000 worth of contracts, all depending on how much you bought. And now we have our other 90% and of that 4 million plus all your guys's. Like I want to see this be at least 100 million for me to know that we're going to at least hit $8. Okay. If this isn't 100 million, I don't think, like it's probably got to be at least 250 million. Our whole combined nest egg needs to be at least 250 million, I think. So we'll like, we're all like, it depends if I can find a smaller company that would require less volume. Like, I'm still doing some research. So we got $4 million right here that I'm getting the stock with. All your guys added it together. Let's just say it's 250 million. Well, I put my contracts in over here at the 100,000 or whatever. Basically, if it goes, let's assume that the $6 price, we're making 60x on our money. So if it goes to $8, our 10% value. So 0.1. So this equals 0.1 times 60. We get 6. So if I put in 4.5 million total into Nokia and we gunned it to $8 a stock, first off, all the money that I put in, my $4.5 million, should be worth about $8 million now. Maybe a little bit more, because like some of my contracts are going to be bought at $5, some will be bought at $6, some will be bought at $7. So let's just assume that my 4.5 million almost doubles in investment to 8 million. I mean, let's be conservative and just say 6 million. I don't really care. I'm down to lose all 6 million because our option value, when it goes to, so this is when the stock price is at $8, our option value has turned into 6x over the 4.5 million. And so basically I just made 25 million from the hedgies bank accounts. So I'm going to cash out 100% of this 25 million. And I'm probably just going to leave my stock in there, my 6 million, because I basically got it for free now. And I'm just going to leave the Nokia in there. And hopefully, like, you and all of us own enough Nokia that can be our technology company when we start our own cell phone companies, when we start our own Facebooks, when we start our own everything, to freaking get rid of the establishment, you know? And so that's like the idea behind the squeeze, guys. I hope that all makes sense. That's where my head's at. I don't know exactly how this is all going to play out. Like, I got some GME options and some AMC 2023 options, both GME and AMC. GME 950 strike. Let me show you my bank account real quick. So like, if this thing didn't demystify options for you, I just don't think, like, I think you need to keep watching it and keep watching it and keep watching it, because, or ask smart, intelligent questions of something that I made, like, glossed over or didn't explain very well. But otherwise, like, it's going to be on you guys to do your own research, and it's going to hurt to like think this hard. Like, it hurts your brain to elevate it to new levels, and it's going to feel hard. I promise you, it will feel hard. So I have $100,000 almost dead even right now. And if we go to my account balance and we go to market, positions, basically I got 76,296 in 374 contracts of AMC January 2023 $40 strikes. I got $5,000 in April 16th, $800 strikes, 50 contracts. And I got 4 contracts, GME 2023 $950 strikes at $16,000 a contract. If GME hits $800 before April, I expect this $5,000 to be worth $300,000. And I'm going to put all that into my AMC 2023. And then maybe half of it into my GME 2023. But basically, if GME 2023 hits 950 strike, these are going to be like, if I wait till 800, I'm not going to be able to roll this over into the 950. So maybe if like at 400, these are worth a lot, maybe I'll roll them all over into 950. The 950 hasn't grown much, because basically when this hits, when GME hits 500, this is going to have 100x, but this is only going to have 40x. So basically I'll be able to roll this over into here and buy twice as many contracts as I could right now if I just rolled them over right now. And so I wanted to have some contracts on the same time that Roy and Kitty did. And so I bought a little 50 contracts right here. But otherwise I got $16,000 on the 2023 for GME. So most of my money's on 2023 for both AMC and GME. And if GME hits before the next 2 weeks, I'm gonna cash out these 50 contracts, roll them over to 374. But even if GME hits 950, I'm not selling these 4 GME contracts. I'm gonna hold these 2023 contracts until after we squeeze the other stock and then come back and gun the GME. When GME hits anywhere from 100,000 to $1 million a share, I will consider cashing these GMEs out for their intrinsic value. And so I'm going to hold on to these bad boys for sure. I think the only other thing that I can show you, like, intrinsically, is how bad options make profits. if they get expensive. And so, for example, GameStop is super pricey. So 1 week at the money expiration is $18.75 per contract. So the current stock price is $192 and it's $18.75 is the ask price. And it's $192 a stock. Okay. So we saw in this one at the $6 one that's at the money. So it's $6.50. It makes 60x on its money when Nokia does 100% on its stock price, right? Well, in order for the stock price to make our $18.75 at the money GME 1 week to expire gain 60x on its money, let's see what that would require. This times 60. So that equals, so it'd be new price minus old price divided by old price. And this is a percent. So in order for the at the money GME to pay the same X's as the at the money Nokia, where one's $18.75 ask price and the other is 6 pennies ask price, the GameStop has to go to $11.25 a share, where Nokia only has to go from $4 to $8. So basically, Nokia needs 100% to get me 60x, while GameStop needs 486% to get me 60x. Does that make sense, guys? That's the best. Like, if you guys watch this video 100 times, I promise you, I just went over everything you need to know about options. This video is the video. Like, as long as you like know people that have an attention span that can watch this and like actually want the knowledge, I promise you this will get through to them. This is the video you got to share to people. This is what will get people to buy the January 2023 AMC. Oh, I got one more thing to talk about. We're going to talk about short interest. Okay, guys? So I've already shown you how the cheaper the contract makes more money. Well, now look, Nokia has 3 million open contracts. Check this out, guys. So if we come here and we go to AMC and I go to options, and then January 2023 is on the list. I come down to the bottom and then I scroll over. There's a thing called on the call side. I only care about call open interest or put open interest, whether you're trying to squeeze it going down or squeeze it going up. You can only squeeze one side at a time. So only count one side at a time. But basically, if we look at this, guys, we'll see that there's where I have 374 contracts, there's 6,000 open contracts right now, plus 250 bought on Friday. So this will update to probably about 6.2 on Monday. There's 9.3 thousand open on the $30 strike. 800,000 of this was from one of my investors in my chat. And if you count all these contracts up, each one of these contracts represent 100 synthetic shares. Okay. So that's how people count short interest percent. Each one of these open interest contracts on all the expiration days of one symbol is how you add up the open interest on one stock symbol. Okay. So check out Nokia's 2023, guys. Check out Nokia's 2023. I already told you the cheaper the contract, the greater the squeeze. Well, I found a couple companies like this, and check this out. 234,000 contracts, 209,000 contracts, 126,000 contracts. Now we know these are all super cheap, $100 a piece, $50 a piece, $1 a piece over here, or $20 a piece over here. Like, we know that these are all super, super cheap. And so it's not a lot of money that's on here. But what we know is that the cheaper contracts actually make more money than the expensive contracts. And so by squeezing this, you're actually hurting the hedge funds more, and you're hurting them with other things. And so I found a couple like Nokia that the only thing I don't like about Nokia is the 4 billion shares, and like 4.2 billion are on the float. And so basically, like, nobody owns Nokia right now. Like, they're like all the share, like 80% of the shares are available for purchase right now. And so I don't know if that makes it harder to squeeze, and if we actually need $2 billion to squeeze. If we get $5 billion from AMC and as all together, like, we'll go squeeze Nokia no matter what. And we're going to go buy Nokia, and we're going to make 6x whatever we put into it that we're going to cash out and then go gun AMC and GME with. Does that all make sense, guys? Like, I really hope this is clicking for you guys. I really hope so. The last thing that I'm going to go over, guys, the very, very last thing that I want to go over is if we look at so I showed you guys the 1 week to expires comparisons. Now, if we look at the 2023 to expire option pricing, a GME at the money contract costs $11,000. GME $950 contract costs $4,000. An AMC 2023 at the money costs $465. An AMC $40 strike, so 300% out of the money, costs $195. And then Nokia, a $4 strike at the money costs $102, while a $17 strike, 300% out of the money, costs $26. And basically that $26 contract, like basically when GME hits 950, when AMC hits 40, and when Nokia hits 17, I expect the option prices to all be relatively the same price. I expect AMC to probably be half the option pricing of GME, and I expect Nokia to probably be half of what AMC is, meaning our ROI factor on squeezing a Nokia-like company is way better than AMC or GME, but AMC is way better than GME. But ultimately, the real retail diamond hands is in GME. So after we're done squeezing, we definitely go gun the GME and AMC, because these are the only two places where the retard apes are diamond handing. The ones that can't think about options and all this other stuff, this is the only place that they're actually putting their money in diamond handing that I can find, that I trust. And is also the place where the government is fighting against. And so when inflation hits and eats everything else, I believe that if you bet against society, if you bet against the Fed, if you bet against them halting the stocks, that you will be blessed and you will be rewarded. What else? Man, I hope you guys liked the video. I feel like this was probably the best video yet. This was that real DD. Yeah, that's really all the DD I got, unless you guys got questions. I'll go over any questions you guys have now. Then after this, I'm going to go over the honor code stuff. And the honor code will be the only way to remain in my Discord and hear the message of which company I'm actually going to squeeze and when I'm going to squeeze it. Thank you, Zazu. I hope you guys are pumped for tomorrow and next week. Sale maker, the market is designed to be liquid. If you do a market order, you will always be filled. The Fed will buy your contracts. You can fill any order in the entire market if you're willing to pay the right price or sell at the right price. And believe me, the price will be more than enough of what you're needing. Yeah, after I save this video and put it onto YouTube, I'll send it to that mod that could definitely get me the platform that I need. But remember, guys, when we were reading the Bible a couple Sundays ago, it said we only needed 10,000 people for this part of the journey in order to get to the next phase. And so we're probably already close to 1,000 people that have invested into some of my advice, whether it's the June 2023 or the June expiration or the 2023 expiration, but the $40 strikes and any of the 2023 strikes, if you add up all that, there's probably about 1,000 people that have invested. And so we need the 10X are following, and we should be ready to make our tendies. I believe we'll make our tendies as soon as we do that. But with our boy, Elite Shot coming into the house with his 1 million YouTube subscribers, he said he's going to try to do what he can to get our message out. So we got a lot of exciting things to look forward to. And I feel like we're getting paid this week on GME at least. AMC might be two more weeks from now, but I feel like GME is going to pay something. All right, guys. If there are no questions, then it looks like you guys just love the info and I don't see any questions. Curtis Kurt S says, learned more today than 3 weeks of my own research. Thank you very much, sir. Kurt S, I've been doing this for 2 years, buddy. You had a long journey ahead of you if you've been doing it for 3 weeks. You had a long, long journey ahead of you, brother. So I'm glad I could help you out, man. I really am. If you guys do you guys agree that with the knowledge that I just shared with you, as long as you're looking at the option market and everything, all the rules that I just showed you to follow are always true in any strategy that you're trying to come up with, you'll know that your strategy is legit. And so, yeah, I hope you guys saw enough to understand that anyone that's talking about the Greeks inside of options are just total clowns. Total clowns. They don't understand options. This is how you understand options. And I hope there's no more when people say, how do I value my options? You guys just refer this video and you guys stop sharing the options profit calculator link, because I've seen you guys share that link a couple times and it's bothered me, but I haven't known how to describe why it bothered me until now. And so that's part of the reason why I wanted to make this video, was so that if we share optionsprofitcalculator.com, it's with the huge note of this thing highly under exaggerates your performance. They're trying to tell you you'll make less money than you will. And it's probably not an evil thing. It's probably just because they're not smart enough to figure out a better way. But yeah, I put in the work. So we will be blessed for that. Whew. All right. We got all the stuff. Now I guess I just got to write my honor code. We'll see what this last comment is, and then I'll start writing the honor code, and you guys can see what that's about. And I won't actually make my Discord private until after we get paid from AMC. And so Discord will be open for everyone. We can still have fun in the chat and everything. But as soon as we get paid on AMC, Discord's going private, and only people that filled out the contract or the honor code will be invited into the future private Discord. What is HC, Thurbo? I'm just going to post a link on my Dropbox and share a link with you guys, and you guys will have to print it out and sign it, or just I don't need, it doesn't need to be fancy. You can screenshot it on your phone and then just do the picture update thing and write it'll be very, very, very simple. You guys will see how simple it is. It's very, very simple. I just want just basically you showing minimal effort that you're actually listening to me and all that good stuff. All right, so I'll go ahead and start writing this out. All right, file, save as, desktop, honor code. First name, last name. So you guys will obviously put your own first name and last name on this honor code. Then it says, I hereby agree and testify that the information Marcus Ray shares is pure, helpful, and not financial advice. Simply mathematical proofs that I am able to comprehend myself and personally feel is the right, and personally feel qualified to make my own adult investment decisions myself. I agree. I will not take Marcus's advice about being an adult or having the permission of my guardian. I also agree to support Marcus's full plans in all squeezes and eventually the gunning of the GME and AMC common stock through some form of market orders and limit orders equaling to a percent of my earned profits cashed out from the AMC place. Signed, a smooth-brained ape watching the God Pill. Print name. Date. And then the last thing will be percent of account willing to risk to the end. Basically, the percent you will bring to the next squeeze, and then when cash out for another 6 to 100x with the next squeeze, the same percent of those profits you plan to bring to the GME AMC gunning of stocks. Marcus Ray, the God Pill, pledges 50% of all options profits at each profit moment will be used to compound to the next event. Your percent committed. Committed. All right, guys. What do you think of my honor code? Everyone think it's fair enough? If you are in it to win it, you must be willing to sign that honor code. Otherwise, you can enjoy my YouTube channel as much as you like, because that is for everybody. But this Discord will be eventually, after we make money on AMC, this Discord will only be for people who have signed the honor code. All righty. Guys, I believe that is all I have to say. Are there any final things before I hang up and we just celebrate on Monday when we start making some tendies? Anything else that I'm missing, guys? Any questions? Oh, okay. I'm going to turn off my Zoom. We'll call that a day, and then I'll start downloading that video.